Okay, let's talk about the demise of corporate finance.
Oh, okay.
With this chart as the backdrop, I'll come back to this in a second.
Okay.
So, if you think about companies, they have revenue, they have profits. They might return some of that capital to shareholders, right? They might issue a dividend. They might buy back stock. The third option is to make an acquisition, and the fourth option is just to hoard the cash.
Mm-hmm.
So most companies in this day and age, the gold standard is stock buybacks.
Mm-hmm.
That most companies, if they pay a dividend, it's pretty small. It's just to kind of satisfy the dividend crowd that wants some dividend payments, but it's not really a driving thing in the world of corporate finance anymore. Most people think that returning capital by buying back shares is more tax efficient, right? The people that are selling, they pay the taxes. Everybody else doesn't have to pay the tax on the income from dividends.
Right.
So if you think about what's happening then, though, we've got all these companies that are very successful now that are heavily incentivized to return capital to shareholders, which sounds good. But what it means at the company level is that companies are perhaps less financially secure, right? They've shed all this capital because if they didn't, their return on capital would go down,
Oh, that's true. Yes.
right? So there's been a good reason for it from that perspective because, just having cash on your books earning, 3, 4, 5%, that's probably lower than the rate of return they're getting on their operating businesses, hopefully.
Right.
So that's been the gold standard in the world of corporate finance is return capital to shareholders. Apple has been tremendously successful in doing this. NVIDIA now is a huge stock buyback program, as does a whole host of other companies.
Yeah. And again, not to turn this into a book, but no matter what size your company is, and I can only talk from the standpoint of a company that my factory, which was about 5 million in sales, at that level, your next product or your next thing that you invest in has to be large enough to make your organization interested. So if you've got a product that's producing 4 million a year in sale, well, in our case, we had one product that was producing 4 million in sales and another product that was doing 1 million in sales. Well, if now the next product you introduce has a potential to only do 100,000 in sales, it's very hard to get your organization interested. So
True.
if you multiply that times, put multiple threes on the end of that, and
Yeah.
you've got an Apple that's got, their Apple iPhone or their computers doing billions and billions, you can't come along and start investing in products whose total TAM is 1 million or 5 million or 10 million. They might be great
That's right.
products, but you can't put it in that organization. So you start limiting and limiting and limiting the products that you can get invested in.
Yeah, and we're seeing that a little bit already with Tesla with the Roadster.
Sure.
It's just not going to move the needle. It's an amazingly cool product. The world wants it, but
Right.
to spend all the executive time it takes to develop it, may not be worth the effort. Although hopefully, again, they do.
Yeah. Mm-hmm.
Um, and so there's one exception to this corporate finance rule, and that's Berkshire Hathaway. Warren Buffett doesn't return capital to shareholders. There's no dividend for Berkshire. He doesn't buy back stock. Now, it's a little bit different because he's a massive insurance company and he's a reinsurance company. He
Right.
insures other insurance companies,
Right.
right? These super cat policies. And so for him, capital is critical. And aside from what he's doing on the insurance side, we saw in the financial crisis that other companies went to Berkshire Hathaway to get funding.
Mm-hmm.
Goldman Sachs famously borrowed money from Berkshire Hathaway in order to basically keep afloat. And Warren was able to extract a pound of flesh for that privilege. So having capital in a time of crisis is kind of important,
Yeah.
right? Now, tech companies generally keep a lot of capital, but they're also, returning a lot too because they're generating so much cash.
Right.
Okay. let's think about now what's going to happen in the next 5, 10 years.
Okay.
We're going to have AI unleashed on the world. We're going to have disruption like we've never seen before.
Yes.
Okay. Disruption, it means opportunity, but it also means the negative side of it, lost employment for companies, lost revenue sources. Some companies will go bankrupt. In general, if you are running a company today, the more capital you have at your disposal, the better you'll be able to weather this potential storm.
Mm-hmm.
And we're seeing that in the development of AI models, that it's becoming increasingly more expensive to build a frontier model. We're narrowing down the number of companies that can afford these, 100,000, 200,000 GPU, data centers.
Or
And
the
in fact,
100,
if xAI is anything, maybe the price of admission now would be 1 million GPU data center.
yes, and of course you also have to now be able to afford the $100 million a year employee, or
There you
multiples,
go.
or multiples of those.
That's right. Um, and so what I'm sort of putting out there as an idea is that the world of corporate finance needs to do a 180. Companies need to stop paying dividends. Companies need to stop buying back stock, and they need to hoard that capital.
Mm,
Now, keeping that in cash and bonds is the wrong thing to do because that's depreciating in value. What I think they should do, and I'm not alone here, is that they should be investing in Bitcoin. And by the way, before you say that's a terrible idea, Tesla's already doing it.
of course, and making money.
Well, this quarter would be very positive, probably a $500 million gain on the Bitcoin. Okay. Now, this is too short of a show to get into why Bitcoin, but Bitcoin is a form of digital capital that is secure, that's not controlled by any issuer. It's kind of the most pristine form of capital there is. And by the way, it's been appreciating very rapidly since its inception and
Right,
continues to do so.
right.
So again, this is not a sermon on Bitcoin, but let's just, for example, let's just say, okay, Cern, I'll accept for now, for the purposes of this discussion, that Bitcoin is a rapidly appreciating asset, right? And that this is a secure place for companies to put their capital. If that in fact is true, then companies should be doing the exact opposite of what they're doing now. They should be hoarding Bitcoin.
Gotcha.
Okay.
Hmm.
Now, we have one company that is going a step further. And you and I have talked about this before. The company is called Strategy. It's formerly called MicroStrategy.
Right,
They're the largest corporate holder of Bitcoin in the world. They have over 601,000 Bitcoin that's worth more than $70 billion.
right,
Okay. And they've been trying to acquire as much as possible by taking the money that is in retained earnings and buying Bitcoin. That's what they did first.
hmm,
Then they sold more of their stock. They diluted their stockholders and bought more Bitcoin,
hmm,
which actually proved to be accretive to stockholders because they were able to sell stock for a price greater than the Bitcoin on their balance sheet.
right.
And what they're doing now is going after the two largest squares on this chart. The value of global assets in the world right now, Randy, is 1,000 trillion.
Okay,
Roughly $1 quadrillion.
right.
Enormous. Okay. The biggest chunk of that's real estate. $370 trillion of real estate in the world. The next biggest chunk is bonds, about 318 trillion. We've got 130 trillion in cash. We have 135 trillion in stocks. And then we have art, collectibles, cars, gold, 22 trillion, and then Bitcoin at about 2.2, 2.3 right now. Imagine for a second that you've got money sitting in bonds earning, let's say, 4%.
Hmm.
Okay. And you say, okay, I don't like that, but I don't have any alternatives.
Hmm.
Well, along comes Strategy, and they issue three new securities. These are preferred stocks: STRK, Strike, STRF, Strife, STRD, Stride. Strike, Strife, and Stride.
Okay.
Okay? Somebody's had some fun with these names.
Yeah, right.
I'd imagine that there'll be a Strive and something else coming in the future. But
Right.
these three securities were issued this year. This chart shows the yields when they were issued. So Strike was issued at about a 10% yield. It has now appreciated by over 40%, and the yield now is about 6.5%.
Hmm.
And the reason is that people recognize the financial strength of these instruments, and they were attracted by the yields. Again, 4% is down here. If you've got bonds yielding 4%, you could have locked in a yield way higher with these.
And just I'm confused. Maybe other people aren't, but these are bonds that they are putting out, or preferred stocks.
They're preferred stocks. They're perpetual preferred stocks.
Okay.
So it's considered to be equity on the balance sheet. It's not a debt instrument. It's equity.
Okay.
But Strike pays a perpetual 8%.
Okay.
Strife and Stride have a perpetual 10%
Okay.
dividend. Okay, so if you are somebody who is looking for income, again, a lot of people invest in real estate for income. A lot of people invest in bonds for income.
Sure.
How many bonds in the world today earn, more than 8%?
Sure.
Right, and this one up here right now is at about 10.5%. And so a lot of investors are yield starved. And so now we finally have an option that's backed by $70 billion of Bitcoin and growing for people that need income to get yields that they're looking for.
Right.
What we're seeing right now, I believe, is the early sign of strategy, formerly MicroStrategy, that's invented a bond market vacuum cleaner. They're going to be sucking money out of the bond market, and it's going to go into Bitcoin. That'll benefit the shareholders of strategy, but also benefit the people that's investing in these instruments because the yields are much higher.
Yeah. But again, the market will out. So to the extent that they are considered to be risk not that to the extent that the market decides the risk valuation of those bonds, we've already seen that they've dropped down to around 6.5%. So they could drop down further.
Yes.
So at some point there could be less risk to the bond markets being vacuumed up as they also adjust.
That's right. There will be an equilibrium at some point.
Right.
Right. And right now, the amount of money that's in these instruments, which is about 3 billion over maybe 3.5 billion, roughly, is tiny compared to the value that's in the bond market.
Right. Right.
Right. So over time, as awareness grows, over time as they issue more, there will be this equilibrium point, and in some cases, some bonds will have to rise in order to be competitive with these instruments. What's more likely is that the yield on these instruments come down,
right,
to meet where the bond market is. Right, but that's one advantage they have. The other advantage they have is they're backed by Bitcoin as collateral, which is the most pristine collateral on the planet. There's no counterparty risk with the collateral in Bitcoin. But with a bond, you've got counterparty risk. Is that company going to go bankrupt due to the AI disruption that we just talked about?
right.
Right. And so over time, more and more people are going to start to be aware of this risk. And they're going to start worrying more and more about the counterparty risk, bankruptcy risk that's inherent in corporate issuers of bonds, particularly of those companies that have given away their capital.
Right.
To tie it back to our earlier discussion.
Right.
Right. These companies are no longer building their balance sheets with capital. They're getting rid of it. Where strategy is doing the exact opposite. Every time they issue one of these preferred stocks, they take the capital and they buy more Bitcoin with it, which makes the collateral supporting these that much stronger.
Right.
And they do it rinse and repeat over and over again. So we're starting to see, I think, Randy, a significant change, or this is early signs, significant change in the way that corporate finance works. and in the way I think that people are going to ultimately derive income. We're going to be moving away from traditional bonds into some of these Bitcoin-backed securities.
Are we going to see other companies following Strategy's approach?
Yeah, there already are 60, 70, 80-ish. They're coming up every day. New companies that have developed a Bitcoin treasury strategy.
Okay.
And then more and more companies will start issuing securities once they get enough Bitcoin in their treasury that they can do so.
Okay. Would we
Strategies is leading the way here in terms of blazing the trail about how to do this.
do you think we're likely to see people with other strategies other than issuing bonds, possibly being a lender like a bank, going the other direction?
Possibly. The issue with that is then you're introducing some risk in terms of, if I lend you Bitcoin, how do I know I'm going to get it back? There are some people doing Bitcoin-backed loans. So if you have Bitcoin, they'll lend you money on the strength of the Bitcoin holdings. And that's a developing area. But I think what we're seeing here is the early signs of, again, of a complete rewiring of the sort of the financial system as we see it. And I realize that when people hear that for the first time, they say, no way, these markets are so large, it's going to take decades. And you're right, it will take decades. But I think we could see a significant change in this in just the coming few years.
Are we also seeing the Goldmans of the world looking at Bitcoin, recognizing that they need to be doing something along the lines of what Strategy's doing themselves?
I'm not aware of whether Goldman is or not, but there are certainly
that class.
Other companies, I think, that are looking at this. And certainly Strategy is using some of the skills of investment banks to issue and market these securities. Right. When Strategy comes to market with these preferred stocks, they might be working with Morgan Stanley, for example, to find the buyers for these investments. So there is definitely a relationship with Wall Street. And of course, the one thing that Wall Street is really good at is jumping on new opportunities.
Of course.
To make money. Yeah.
Interesting.
So, yeah, this is quite fascinating. And for me, the other thing, and I wrote a post about this today, is I think that there's an important tie-in between AI and what Tesla is doing with the demand for Bitcoin.
Okay.
Here's my theory on that real quick.
Okay.